the webinar under the name of Financial Acumen Roadmap to Business Success. My name is Maroun Zghaib, and I'll be the presenter in the upcoming 30 minutes webinar under the topic of Financial Acumen Roadmap to Business Success. So this program or this webinar is an introduction to a program that we are running in 22 to 26 September 2019 in Dubai. I'll be the presenter of this program. As a way of introduction, my name is Maroun Zghaib. I am a CFA charter holder, US CPA, and holder a diploma in IFRS. I appreciate if you can type something in the chat box, something small in the chat box, so that I know that you are hearing me, that you are listening to this webinar. Okay, Muhammad, really, I can see you. Okay. So as a start, I start by introducing the concept of shareholders value. I know that a lot of times everyone tells you value, want to create value for the organization. Is this value adding? What value does it create to shareholders? What value does it create to the company? And every person defines value in a different way. In my MBA, the teacher, the strategy teacher, in fact, he was a McKinsey ex-employee, and he defined value for us, and I would like to share with you the definition. The definition of value that he presented, he said that value is basically segregated into three types. First, we have the value that is captured by the clients. So the maximum price a client is willing to pay and the price that is charged by the company is a value captured by the client. For example, if you are willing to pay for an iPhone 4,000 dirhams, but in fact you are buying the iPhone for 3,000 dirhams, the difference between the price charged by the company, by Apple, which is 3,000, and the maximum price you are willing to pay, the 4,000, that's a value captured by the client. From the other side of the value chain, we have the value captured by the employees or suppliers, which is the difference between the cost of production, the actual cost of production, and the minimum cost. For example, if you are willing to take a job for example, 10,000 dirhams, but in fact the company is paying you 12,000 dirhams, the difference between the 12,000 which you are actually getting and the 10,000 which you are willing to take, this 2,000 is a value captured by the employees or the suppliers of the company. Now, what is the value captured by the shareholders? The important concept is the value captured by shareholders, because at the end of the day, the company, the management, the board, they all have fiduciary duties and stewardship towards the shareholders of the company. So the value captured by shareholders is basically the difference between the price that is actually charged by the company and the cost of production. So if for Apple, the price charged is 3,000 dirhams and the cost of production is 2,000 dirhams, the value captured by shareholders of Apple would be 1,000 dirhams. That's the actual price charged minus the cost of production. What is our job in the company? What is the function of management? The function of management is to try as much as possible to push up the prices in a way that they charge the highest price that the consumer is willing to pay. And from the other side, they try to push down to a minimum value the cost of production in a way that suppliers of goods and services are willing to supply certain goods or services to the company at a lower cost. When we push up prices and push down costs, what happens to the value captured by shareholders? The value captured by shareholders becomes bigger. Under financial acumen, if you have the financial acumen, you will be able to analyze properly the prices that you should charge in the market. So from one side, you will be analyzing the charges that you should charge in the market. From the other side, you will be analyzing the cost of production in a way to push the cost down and to push the prices up to an acceptable level so that the value captured by shareholders becomes bigger or goes up with time. How to apply financial acumen in real life? In order to make proper decisions on how you should actually increase the prices or decrease the costs, you have to analyze everything around you. You have to analyze the macroeconomic trends, which are the economy, what's happening in the economy. For example, if Toyota wants to capture value for their shareholders in Japan, they cannot charge high prices in an economy where there is a recession. They have to do competitive pricing in a way to attract or at least retain the market share that they have. In markets where there is growth, a market where the demand is higher than the supply, in fact, companies can charge higher prices in order to benefit from the surge of the demand that is existing in the market. In order to do this, first you can do an economic analysis to analyze the overall economy, whether we are surviving in a sustainable, growing, expansionary economy, or if we are operating in a recessionary economy. The second thing to analyze beyond the economic analysis is to go to sector or industry analysis. So once we analyze the economy, which is point number one, we go to point number two, which is the industry analysis. Maybe an economy is doing very well, but a certain industry is doing bad. Let's assume, for example, that a certain economy is booming due to improved, for example, spending. However, oil and gas industry is not doing well because there is now alternative energy that is used by companies. So instead of using oil, gas, and petrochemicals, companies are actually using alternative energy. What happens? Maybe the economy will be doing very good, whereas the industry, the petrochemical industry, will not be doing good. Accordingly, if you want to charge prices, you cannot charge high prices although the economy is doing well. For example, what happened in the oil and gas industry lately? Oil prices went down, although some economies were actually sustainable. The economies that rely on oil and gas technically were not able to benefit. The third line of defense, or the third thing that would look at after economic analysis, after looking at the overall economy, after looking at the industry, we need to look at the specific company analysis, which is financial analysis of the company. So one would be economic, macroeconomic. Two, we go down to the industry. Three, we go down to the company specific analysis. And when we perform all this analysis, we'll be able to reach out for conclusions, see the big pictures, and make decisions on what projects to take, the successful projects, and which favorable sectors to go into. Accordingly, if your company is making a decision whether to take a certain project or not, an entrepreneurship project to expand, if in case your company is deciding whether they should diversify in a certain sector or not, if your company decided if they would like to expand into new jurisdictions, new regions, those are the types of analysis that you should undertake in order to make the decision. Now, how to make this analysis? In order to make this analysis, we start first with the economic analysis, which is analyzing the overall economy, analyzing if a certain economy is doing well, if we are going towards expansion, we are going towards recession or not. We say that there are certain economic indicators. The main economic indicators basically are the GDP growth, inflation, interest rates, and unemployment rate. Can you tell me what is the largest economy in the world? What is the country with the largest economy, with the largest GDP? US, that's right, Maruf. US is with the largest GDP. What is the second largest economy in the world? The second largest economy in the world. Try to give it. So basically, Japan is actually the third largest economy in the world. It was the second largest economy. The second largest economy would be China. The third largest economy would be Japan, followed by Germany, followed by the UK, followed by France, and then you have several countries such as Brazil and many other countries. When we look at GDP, we do not look at the size of the GDP. We look at the GDP growth. Why? You can have the largest GDP, but you are not growing fast. If you have the largest GDP and you are not growing fast, it means that you are deteriorating. The economies that are growing fast are the sustainable economies, because if you do not grow fast, it means that either capital is not flowing into your country, or it means that your employees are flying outside the country, or it means that you are not investing enough in technology, managerial improvements, or infrastructure in a country, and all those are very important in order to grow. When we are looking at a healthy economy, we need to look at economies that are growing. We don't need to look at economies that are big. The difference between a growing economy and a big economy. A big economy is as if we are referring to a company with a large revenue. A company with a large revenue does not mean that the company is growing. We don't look at the size of the revenue. We look at whether the revenue is growing or not. The second component that we look at is inflation. Inflation is combined a little bit with interest rates. How to look at it? When a certain economy increases the money supply, it means the flow of funds in a certain country. What happens? When money supply goes up in a certain economy, interest rates increase or decrease. What happens to interest rates? When money supply goes up, the interest rates would, what do you think, increase or decrease? So interest rates increase. In fact, do we have another answer? Would anyone say decrease? So when money supply goes up, in fact, interest rates would decrease. Why interest rates would decrease? Because there are a lot of funds in the market. When there are a lot of funds in the market, the banks don't need your money. When there are a lot of funds in the market, you won't go actually, and if the bank wants to give you loans, the banks have a lot of money and they will give you cheap loans at low interest rates. When the interest rates go down, what happens? Investments go up. When investments go up, unemployment rate goes down. Accordingly, one of the economic indicators, if you are analyzing a certain economy, you need to look first at GDP growth. Second, you need to see at what's happening in the money supply. You would like to see money supply growing. When money supply is growing, this means that interest is actually declining. When the interest start declining, deposits at banks decline. As well, when deposits at banks decline, investments increase. When investments increase, unemployment declines, and when unemployment declines, the overall economy becomes better. This means we are heading towards an expansionary economy. So basically, that's part of the economic analysis. One thing to look at is the GDP growth. Another thing to look at, as we saw, is basically the inflation and the inflation rate. Looking at the inflation, are we along lines with the normal rates? Are we above the normal rates? Are we heading towards deflation? Deflation is bad. I want to know something. Deflation, which is the decrease in the market prices, is bad, because when the market prices are going down, what happens is that people will stop buying. So if you think that the price of this car will go down in the future, you will not buy it today. You'll just wait for the future. And if you wait for the future, and Ridi waits for the future, and Maruf waits for the future, and Muhammad waits for the future, and everyone waits for the future, what happens at the end of the day? If everyone is waiting for the future, naturally the suppliers will start to have decreasing their prices a lot. When they start decreasing the prices a lot, it will be a cumulative effect. It will be a snowball effect with the price decline. And in fact, your economy will start losing value. Okay. The third indicator to look at is interest rates. As we said, we would like interest rates to go down. When interest rates are going down, this means that you are heading towards an expansionary economy. It means that people will invest their money. No one will keep their money at the bank. This helps a lot of companies in order to hire more people, and this will help the economy in a positive way. The last thing to look at is basically unemployment rate, the impact of money supply, the impact of GDP growth, the impact of inflation, the impact of interest rates. At the end of the day, boils down to unemployment and unemployment rates, and no one would like to see unemployment rates going up. We would like to see employment rates going up and unemployment rates actually going down. After looking at the economic analysis, we can analyze the industries. So first, as part of your financial acumen decisions, you should understand if you are operating in a healthy economy or not. The second level, after understanding your economy, after understanding the overall economy, you need to understand in which industries you go and which industries you exit. To analyze this and to understand this, there are several models that have been introduced by a lot of strategists around the world, but one of the most commonly used is the Michael Porter 5 forces. Michael Porter thought that there are 5 forces that would impact or stress the organization. From one side, you have your suppliers, you have the buyers from the other side, then you have potential entrants. Those are companies that you don't know about, but they are considering entering into the market and taking part of your market share. There are substitutes. Those are not direct competitors. Those are items that can substitute your existing product. Pepsi-Cola and Coca-Cola can serve as competitors, but Pepsi-Cola and Starbucks are actually substitute, because if you don't want to drink, for example, coffee, you can drink soft drinks. And then we have the industry competitors. Those 5 forces impact any organization, or they impact the sustainability of a certain organization. We look at horizontal pressures. The horizontal pressures are your peers. Those are the potential entrants. Those are the substitutes. Those are the competitors that are around you, and they are considering all the time how they would snap a market share out of you. The second type of pressures are the vertical pressures, which are the suppliers, buyers, and sometimes the competitors as well. When we are analyzing if a certain industry is healthy or not, when we are analyzing if it's an industry to go to, would like that entrants cannot go inside this industry. We would like to go into an industry that substitutes do not really exist. Industries that substitutes exist can actually be harmed left, right, and center. From any place, from anywhere, you can receive a threat. You would like to go into industries that there are no lot of competitors, or the competitors are not very aggressive. They don't copy you instantly. And industries where the competitors copy you instantly, those are industries that are threatened. For example, nowadays, Apple, if they cannot sustain their diversification, if they cannot sustain their competitive advantage of having a special product offer in the market, Apple in couple of years might actually be overrun by other competitors in the market, such as Samsung, Huawei, or the others. You need to look at the bargaining power of buyers. Sometimes the buyers have strong bargaining powers. If the buyers have strong bargaining powers, they will start putting pressure on you to reduce the price and increase the quality, and this will cost the company a lot. And we need to look at industries where the suppliers are not actually strong, or suppliers do not control us. We would like to operate in industries where we control the suppliers. Accordingly, when a company is deciding whether to go in a certain industry or not going in a certain industry, you need to put a score of 1 to 5. It can be 1 to 3, it can be 1 to 10, about the strength of potential new entrants, about the strength of the suppliers, about the substitutes, about the buyers in the market, the customers, if they are strong or not, and about the industry competitors. This is the second line that you should analyze. So the first line that you should analyze is the economic analysis. The second line is the industry. And the third line that you should analyze is the financial statements, or going into financial statement analysis. To go into financial statement analysis, you should basically look at the company from multiple perspectives. The first perspective that you would look at is analyzing the company over time. When you analyze the company over time, this we call it time series analysis. For example, we'll be comparing year 2018 versus year 2019. So you see if you actually improved or your performance is deteriorating from one year to the other. So this time series analysis is important to understand if you are doing better or worse against yourself. However, it's also important to see how you are doing in line with the competition, comparing other companies. This we call it cross-sectional analysis. And the cross-sectional analysis will have two companies. We'll have company A and we'll have company B. And for both companies, A and B, we'll be analyzing, for example, year 2019 versus 2019 to see which company performed better during that year. Both analyses are important, because looking at yourself alone is not enough, and looking at the competition alone is not enough. You need to see how you're performing against yourself and how you're performing against the comparable and competitive companies in the market. So this is the comparing against competitors in the market. To do the analysis, we need to rely on the basic financial statements. The basic financial statements are comprised of 5 accounts. The first financial statement, which is the balance sheet, it shows you a snapshot as of a point in time of your assets, what you own at a point in time, the resources owned by the company, what you owe as liabilities at a certain point in time, and the net equity. I usually say assets are what you own, liabilities are what you owe, and equity is what remains to the owners. So it's the OOO. It's the triple O effect. What you own minus what you owe is equal what remains to the pocket of the owners, and you always want the owners to be happy and smiling. So the balance sheet shows us what we have at a point in time. We can analyze it. From the other side, we can look at the income statement. The income statement shows us our revenues and shows us our expenses. So what we really need to have is to have revenues that are bigger than our expenses, and it's usually prepared over a period of time. It can be prepared over a period of quarter. It can be prepared over a period of year. Okay, so it can be over a quarter, specific quarter, or for a certain year over a period of time, and you analyze how your performance is improving or deteriorating. To do the analysis over the income statement and balance sheet, one of the important things is to break down the costs between variable costs and fixed costs, which is something we'll see later on. The types of analysis that you can perform on the financial statement can start with the liquidity ratios. If you are liquid or not. Liquidity ratios is basically analyzing the short run or long run. When you are interested in the liquidity, are you interested in the short run of the company or the long run of the company? Okay, so Muhammad is saying that it's about the long run. Ridi is saying about the short run, and Maruf is saying about the long run. Gentlemen, I'll have to say that Ridi's answer is right. When we are analyzing liquidity, we are more concerned about the short run. We are concerned if we have enough current assets in order to settle our current liabilities. And this is a nightmare for the company. Most of the companies, when they find difficulties because they are not collecting enough from customers to settle to their suppliers. And when we have this problem, when you cannot collect enough from customers to settle to your suppliers at a certain point in time, you might have to lay off some employees, defer the payroll, defer the payment to suppliers, and this will harm the relationship. And if one of the suppliers did not get his money on time, you might end up not being accepted by other suppliers, because this supplier can have contact with other suppliers in the market and can tell them that this company, for example, Muhammad's company, is not paying on time, don't sell them. Okay, so the first type of analysis is that you need to manage the collections and payments. If you are not into finance, if you are into sales, probably your number one concern is to achieve your targets and sell. But having financial acumen will make you understand that making the sale is not enough. Making the sale and collecting is what generates the actual sustainability for the company. Many times you sell and you don't collect. At the end of the day, you end up with a big amount, with a big number of doubtful receivables or losses from bad debts. Losses from bad debts are bad for the company and they are bad for the salespeople. Okay, so one thing to look at is liquidity. The second thing to look at when we are analyzing the company is looking at the company's asset management and activity ratios. How is the company managing their collections? How many days the sales is outstanding? How many days the inventory is in the warehouse? You'd be interested to know if it's taking you, for example, 30 days to sell the last batch in your warehouse, or it's taking you 60 days. Because if it's taking you 60 days, you might be facing risk of expiry, you might be facing risk of obsolescence, of theft, of destruction of the product. Accordingly, analyzing the number of days would be important. The number of days of payables. I would like, for example, to collect in 30 and pay in 60. That's what you would like. But in fact, what's happening? In fact, what's happening with the collections versus the payments? This analysis, we will convert the theory into numbers. We can actually do the calculation and understand how many days it's taking the company to collect, how many days it's taking the company to pay, and on average, how many days the inventory is staying in the warehouse. We look at turnover ratios of the assets. If your assets are actually being used well, how you are using the assets, the firm's use of its assets, okay, whether they are fixed assets or whether they are total assets in order to generate revenues for the company. The third set of ratios is about the financing structure. Are we using too much debt or not? I want to ask you a question. Is using debt something good or bad? What do you think? Using debt, using loans. If you obtained a loan, if a company is obtaining a loan, is using a loan something good or bad for the company? Bad. Maruf saying bad. Jislani is saying bad. It depends. Bad. So we have 3 bads and 1 it depends. Really, why does it depend? It depends on what? If I am using a loan, why can it depend? That is cheaper. Yes, that's right. Sometimes that is cheaper. I'm gonna tell you a personal story. That is cheaper. That's totally right. But not in all jurisdictions. Not in all jurisdictions that is cheap. When I came to Dubai, I was a young 29-year-old man coming from Lebanon. I decided that I want to buy a car. When I decided that I want to buy a car, I started looking for cars. And then after a couple of months, when I decided on the car, but sometimes equity is better for the company. You're right. So let's look at the example. I decided to buy a car. So I went to Al Nabuda. I saw a car and I told the showroom manager that I would like this car. I decided to buy it. We started filling up the documents, and then the Nabuda guy told me, would you like to pay cash or you would like to take a loan? I said I would like to take a loan. He asked me, how much would you like to take a loan? I said the maximum possible. Do you know why? I said the maximum possible because if I took a loan for a new car in Dubai, I would pay an interest rate of 2.7%. So I'll be paying an interest paid of 2.7% on the car loan. However, I had the funds, but I can invest the fund and I can get an interest received in the bank at 6% in the US dollars, eliminating the currency risk. Many times the company have the funds, but instead of using their own funds, they can go to the bank, obtain a bank loan, pay to the bank an interest of 4, 5, or 6%, and they can invest the funds and obtain a return of 10, 12, and 15%. Accordingly, using debt is not bad. It depends on the cost of the debt that you are using. So when you are deciding whether you use debt or not, you need to look at the cost of current liabilities, which means the short-term debt. You need to look at the costs of the long-term debt, long-term loans or long-term liabilities, and you need to look at the cost of using your own money. By analyzing those 3 costs, you would decide on the ratio, how much you would use short-term debt, how much you would use long-term debt, and how much you would use equity. When you possess the proper financial acumen, you will be able to make proper choices. You will be able to make good decisions that guides your business to success. You'll be able to decide if you would fund your expansion through using loans, which we call them as liabilities, or we use equity, which is using the shareholders' money, would look at the cost of funds, and based on that, you will make a calculated decision rather than an instinctive decisions. Let me tell you something. Decisions that are based on feelings, decisions that are based on instincts are not decisions. Those are speculation. Those are gambling. And finance, if you would contribute, you should actually provide the decisions based on numbers and calculated figures. The other type of analysis is the profitability analysis. We need to analyze our income statement. We need to analyze our profitability. How's my gross profit margin performing? How's my operating profit margin, net profit margin, return on total assets, return on equity? Your shareholders contributed equity to the business. They contributed funds to the business. Return on equity is analyzing how much we generated net income to the shareholders' equity. This would generate a percentage, and we'll compare this percentage to my competitors in the market to see if we are actually generating to the company and to the shareholders enough return, or I will be fired at the end of this year. So basically, you need to verify that you are achieving proper enough good returns to the shareholders. Otherwise, the shareholders will not like this story a lot. Then there is the cash flow statement. We analyze the cash flows as well. Cash flow is super important. And when we analyze cash flow, we need to understand that companies pass in several stages. The companies pass in a startup phase. Then they have a supernormal growth phase. In the supernormal growth phase, their market sales start increasing very fast. Some companies that do not grow, they die over here. If the companies did not die over here, they can continue their growth in this cycle. Then they reach a ceiling. Under this ceiling, it is the maturity. And this maturity, if the company starts decreasing, and here we have something called innovate or die. That's where the definition innovate or die came from. Many companies that did not innovate actually died. BlackBerry died, they did not innovate. Nokia died, they did not innovate. The other competitors in the market were faster. They were much faster in the expansion. They were much faster in actually breaking through the market with new innovations. Kodak is a company that did not innovate and they died. And look around you, many companies that you hear about them, they actually die at a certain point in time. And if this happens, actually, you start going down at a certain point in time, you need to innovate and renew, otherwise you'll continue the decrease. When we analyze the cash flow statement, you need to understand that at every cycle, you will actually be having either negative or positive cash flows. And those negative or positive cash flows, they will come either from operating activities, which are the sales to the customers and payment to suppliers, or they can come from investing activities, which are investing in fixed assets and other resources, or from financing activities. At the early stage of the company, which means at this stage, you would expect that the operating activities, if you are at this stage, would expect that the operating activities of the company would be negative, will be making losses. Investing will be negative because the company will be investing in resources and property, plant, and equipment, but the financing from the shareholders and the banks will be positive. To possess financial acumen, it means that you understand what would happen at every stage of the company's life cycle. What would happen in the startup phase, what would happen in the growth phase, and the maturity phase, and in the decline phase, and how to get ready at each and every one of those stages so that your company does not fail. Another type of analysis is going in depth and starting to analyze the cost of the company. One thing to analyze in terms of the cost of the company is to analyze the fixed cost versus variable cost. The structure of whether you have fixed cost or variable cost is very important. Many businesses are actually now the biggest companies in the world because they changed the structures. For example, Apple was able to kill most of their fixed costs and focus on variable costs. How? They closed their warehouses, they closed their manufacturing facilities, they outsourced everything for production in China. And now if you look at the back of your iPhone, I'm pretty sure that some of you have an iPhone. If you look at the back of your iPhone, you will see that it was designed in California, assembled and manufactured in China or any other location. How did this help Apple? This helped Apple because Apple has a lot of down season. They have low seasons. And those low seasons, they are not producing a lot. What are those low seasons? Those low seasons are actually between April and the month of October. Between April and October, Apple is busy with the design. They are not busy with the production. In the design phase, if they have a lot of factories, if they have a lot of employees in the factories that are doing nothing, they will be incurring a lot of costs, but no profits coming to the company. Accordingly, in the financial acumen, you'll be able to understand and analyze how your structure is, how much you have fixed costs versus variable costs. What are fixed costs? If you want to analyze fixed costs are costs that remain the same regardless of the quantity of output. The rent. Regardless if you produce 1,000 items or one item, you're going to pay the same rent. Administrative salaries, regardless if you actually produce 200 items or one item, you're going to pay the salaries. Depreciation, regardless if you have 20 customers or you have 100 customers, you will depreciate the item at the same pace. Those are fixed costs. Variable costs are the costs that change with the output. Variable costs are the cost of raw material. Variable costs are the commissions paid to sales employee, delivery charges. So for example, let's assume that you are buying items from Noon, from Amazon. The delivery from Amazon to you is a variable cost, but the salaries that they pay for their marketing people is a fixed cost, because regardless if Amazon sold during this month 1 million items or they sold 10 items, they're going to still pay the payroll for the marketing people. But if they sold 10 items, they will pay delivery for 10 items. If they delivered 1 million items, they will incur delivery for 1 million items. Those are the variable costs. The variable costs, so basically, are the costs that change when the activity changes, such as delivery, cost of goods sold, and commissions that are paid to the salespeople. You need to understand your variable cost and fixed cost structure, because by understanding the structure, you will decide if you should go from variable to fixed or from fixed to variable cost structure. Other types of analysis is analyzing a cost per product, segment, or customer. We need to see if a certain product is doing good or bad, if certain segment is doing good or bad, if certain customer is doing good or bad. Maybe the customer is incurring the company losses. Maybe a certain product is a product that is incurring the company losses. What happens? You terminate it. Look at GE. They sold part of their operations. Look at Philips. They sold part of their operations. Many companies try to spin off, they try to stripe out part of their loss-making operations in order to keep the profitable operations, and this will reflect positively on the bottom line. Then you can make analysis about whether you make internally or you outsource. Payroll department. Would you outsource the payroll function or you have it internally? You, for example, let's assume that you need a component for the production of an equipment. Do you produce it internally or you outsource it from outside? Those are the types of decisions that you can do when you possess a proper financial acumen. And while doing this, you need to assess what are the relevant costs and what are the non-relevant costs. When you possess financial acumen, you will be able to distinguish between what is a relevant cost and what is a non-relevant cost. Many people who are not finance professionals, when they look at the cost, they say, okay, let's do the analysis. All the revenues from this department or product minus all the costs from this product equal a net basis. If it's negative, I'll terminate it. If it's positive, I'll keep it. No, because there are many sunk costs, there are many committed costs, there are many non-cash expenses that you have to consider within this analysis. Sometimes you have general overheads that you cannot get rid of even if you terminated a product. This does not mean that you terminate the product. Okay, so when you are doing the analysis, having proper financial acumen means using your acumen in order to know what relevant costs are, what irrelevant costs are, and do the proper calculation to reach the correct conclusion of whether to keep or terminate a product line segment, whether you outsource or you do internally. So basically, that's it. And the last thing, based on all the analysis, and when you possess the right financial acumen, you'll be able to make the right decision on the pricing structure of the company. What do we do with our prices? Do we increase our prices or we decrease our prices? Remember, what is value? Value is the difference between what you make, what the price that you charge to the market minus the cost that you incur. And we always have the intention, we always have the goal, we always have the benefit in order to increase the prices to bring value to the pocket of the shareholders, and to decrease costs in order to also gain profits to the pockets of the shareholders. Okay, those decisions are the decisions that keep Coca-Cola and Pepsi-Cola awake at night. Should we decrease our prices? Should we go into competition, or we should maintain our prices high? Should we go into competition or we go into price war? That's a decision that you need to take based on the analysis of your cost structure and based on the analysis of your costs. That's it. Regarding the financial acumen, remember that this course will be conducted in Dubai between 22 and 26 September. This course will take you over all the topics that we have discussed today and many other topics. We'll discuss what value is, how to look at value. We'll look at economic analysis. We will analyze real economies in the region. We'll look at industry analysis. We will analyze actual companies from companies operating here in the region and global companies. We'll do financial statement analysis using Excel, and we will analyze the cost structures, fixed cost, variable cost, relevant cost, and irrelevant cost to decide whether we terminate a product, terminate a segment, continue dealing with an employee, with the customer or not, decide if we make a product internally or we outsource it, or decide as well how we go regarding the pricing. That's it for the financial acumen, and now I'm going to give you a window in case you have any questions to ask. I'll be more than happy to answer your questions. If anyone has questions, please, you can type it in the chat window. Will the course be available online? The one on the 22nd? Muhammad, I would have loved if the course would be available online. However, at Meirc, we currently don't offer a mirror of our classroom courses. The courses are conducted in Dubai and 5-star hotels over a period of 5 days. For the meantime, we don't have this. Maybe later on we will have it. We'll let you know. In case we started having online courses that you can have access to, we will let you know. We are in the process of getting into online training. Once we have it ready, be sure that we'll reach out to you. Thank you, Muhammad. Any other questions that you have? I can see other participants who are here, who are attending the session. Are there any other questions that you have regarding the topic? Anything technical, anything theoretical? Maruf, thank you for attending. Any other questions? I can see that we had other participants as well attending. Thank you, Jaslani. Reedy, thank you as well. All right, so that's it. I think if there is anyone else who would like to ask questions, please let me know. I'm gonna wait here for 1 minute. Otherwise, I would like to thank you for your attendance. I would like to thank you for sparing this 45 minutes on a Thursday afternoon. I hope you have an amazing weekend to refresh and re-energize and get back to your work on Sunday. Thanks a lot and have a great weekend.
Meirc.com